INBrief with Gabriel Ng, Managing Director, Neuberger Berman, Singapore. Gabriel, thank you very much for coming across to the Inside Network's Alternatives Symposium Sydney.
Oh, it's a pleasure, and thank you for having me.
It's a great pleasure to have you. You have a rich history of experience across the private equity space. Could you give us a quick summary of that journey?
Yeah, sure, absolutely. So I started my career in investment banking. I was part of the Merrill Lynch M&A team in Hong Kong. So I spent 2.5 years doing that before I moved to the buy side. So I joined a US buyout firm, but was part of the Asia team in Hong Kong as well. And then after a stint on the GP side, I actually moved back to Singapore, where I'm from originally, with the Sovereign Wealth Fund, GIC, and spent about 3 years there before joining Neuberger Berman, where I'm now part of the global private equity team based in Singapore, and been there for the last 5 years.
That's a great perspective to answer this question. How has the opportunity set evolved over your time in private equity?
Yeah, absolutely. Through the last 15 years I've been in the industry, I've witnessed the private equity market significantly deepen and become a much larger addressable market. We see very successful global funds continue to grow from strength to strength, raising larger vehicles and diversifying. At the same time, we see emerging managers come out of the system, raise their own funds, and also scale up over time. So all in all, I think all this has created is a much larger opportunity set for us to evolve and to invest into. I think one interesting observation has also been the secondary space, right? If you look back 10 years, secondaries globally was probably about a $25 billion market. Today it's north of $100 billion. So I do think that that ability to provide that liquidity to private equity investors has been important, and that has helped that sector grow. And of course, more recently, what we've noticed is increasingly democratization of the private equity asset class, really, solving for some issues, right? Allowing small investors, individuals to gain access to, what we think is an attractive asset class that has delivered outperformance over time.
Do you think investors are really now appreciating that they can have a continuum in their equity allocation all the way from private through to public?
Yes, I think it's important to be, to sort of construct a diversified portfolio, right, of, stocks, bonds, and also private market assets. And, with the, evolution of, not just private equity, right, but private credit, real assets, real estate, I think it's just given an allocator more options to be able to optimize his portfolio. So we do believe that there's a role for all these asset classes to play in an investor's portfolio. Of course, the exact composition would ultimately depend on risk appetite and liquidity needs, etc.
Are you seeing companies stay private for longer and grow much larger than ever before as private companies, and in many cases never even really think about going public?
I guess we see both sides of that spectrum, right? I think we track this number, which is the number of private companies in US, and that number has significantly ticked up over time. Whereas if you looked at the absolute number of listed companies, that actually has moved the other way, right? But of course, the IPO market represents a very viable route for a private equity sponsor to realize an exit. So, and as they have finite durations of their funds, and where it's suitable, they tap on the public markets to, list a company and to exit eventually. But, I think that's the beauty of private equity, right? You have multiple exit options. You could, go to the public markets, you could sell it to another sponsor, or you could sell it to a strategic. So, I think we like that flexibility.
Where are you seeing the best opportunities in the current market cycle? And I'm asking sectorally and geographically.
Sure. From a sector perspective, we typically focus on two things. I think number one, we got to believe that there's strong secular tailwinds that continue to drive that industry. And second of all, amidst the macro softness, we're definitely going to be focusing on more defensive and resilient sectors. And just to name a few, I think number one is software, right? The providers of software of mission critical applications to companies tend to have very sticky customer bases. high percentages of recurring revenue and visibility on cash flow. They also tend to be very cash flow generative. So these are all characteristics that we like as a private equity investor. The second, key sector is healthcare, right? Obviously a very defensive one. We play across the spectrum, from healthcare delivery to health tech, to wellness, to medical devices. So we do believe that healthcare is a very defensive sector. The third one is really consumer, and we're more focused on non-discretionary consumption. So that's been a space that we've done very well in co-investing into some of these opportunities. And the opportunity set in Asia is a little different, right? There, you're really sort of capitalizing on that growing middle class, that aspirational middle class with larger amounts of disposable income. So there's going to be a natural demand for these consumer goods. And then, of course, industrial technology, right? Essentially, companies that provide services that help other companies become more efficient and productive. So this is anything from automation to water treatment to value-added services. So I think that's another key space that we're looking at. And look, from a geographical perspective, for us, we like to be diversified, right? And I think our weighting is largely in line with market, right? If I look through our private equity sort of exposures, I think the vast majority will still be in North America, right, where the deepest buyout market is. We do, obviously a meaningful amount in Western Europe. And then, we also have some allocations to Asia and rest of the world. And for Asia and the rest of the world, it's a bit more of a growth equity play. And, there are very attractive markets that present that opportunity, from India to Southeast Asia. So we do believe that it's a very large addressable market for us to tackle.
And what do you see as the major potential risks in 2024 and beyond?
Yeah, so in my perspective, I think a prolonged economic softness and challenged economic environment continues to be a big concern. But when we're looking at private equity investments, we're typically investing for the long term. So we certainly take a longer term view, and we're also definitely pricing in all sorts of scenarios as we do our underwriting, recession case, soft macro case. Just to make sure that we're comfortable with the risk reward before entering into a transaction. But I would say that patient capital and private equity has typically outperformed across multiple cycles, and typically in times of disruptions and volatility, that could also be interesting times to invest and generate alpha.
Gabriel Ng, Neuberger Berman, thank you very much for being involved in the Inside Network Alternative Symposium Sydney.
Thank you very much for having me.